Welcome back to the deep dive. Netflix's Q2 earnings are just about here, and wow, after a year with, what was it, a towering 92% return on the stock?
Yeah.
The pressure is definitely on.
It really is. Huge run-up.
Yeah, so today we're digging into a whole bunch of sources. We've got earnings call analysis, metrics, news reports, technical charts, the whole 9 yards. Our goal. Cut through all that noise and figure out what really matters for understanding where Netflix is right now and, what might be coming next.
Yeah, especially why these earnings feel so critical. I mean, the stock's already bumping up against all-time highs.
Exactly. That's the core question we're tackling. Okay, let's unpack this. The expectations for Q2, they're really high.
Incredibly high.
We're looking at projected revenue hitting $11.04 billion. That's up from the $10.54 billion they actually did in Q1.
Right.
And analysts are forecasting earnings per share, EPS, at 7.07. That's also up from 6.61 last quarter, plus a projected 15.5% revenue growth for Q2 overall.
And that precisely sets a really high bar. You mentioned the stock price. $1,263.24. It's right near those peaks.
Yeah.
So Wall Street isn't just looking for, good enough.
Yeah.
They need a genuine upside catalyst, something new, something strong that justifies pushing that price even higher. Any kind of crack, even a small miss, or maybe guidance that's just okay. That could really jolt sentiment.
Yeah, a revaluation for sure. And it's fascinating because, like you said, it's not just about meeting these already high expectations. Look at the recent rally.
Oh, yeah.
The stock's flown up, 31.1% in just the last 3 months. It's blowing past tech peers, even the NASDAQ. So what's really pumping that much fuel into the engine?
Well, the main drivers are pretty clear. First, just blockbuster subscriber growth. They've pulled in over 40 million net adds already in 2024, which is huge.
Stunning numbers.
And second, crucially, that ad-supported tier is expanding really fast. It's now driving more than half of all the new signups.
Which is a massive shift for them, right? They resisted ads for so long.
Absolutely. It's not just another revenue stream. It's like a fundamental pivot. Makes you wonder, doesn't it, about their long-term strategy, who they're targeting now. Is it a different kind of viewer they're going after?
Good question.
But here's the thing. What's fascinating, and maybe a bit worrying for investors, is that while all that growth sounds great, it creates a challenge. The stock's trading at a forward PE, price-to-earnings ratio, of 48.5.
48.5 times future earnings. That's steep.
It is. And the PEG ratio, which factors in growth expectations, is 1.81. Anything over 1, like this, often suggests, maybe optimism baked into the price is a little ambitious.
Yeah, premium valuation.
Very premium. And that means even small slip-ups, minor disappointments in the earnings call, could trigger some pretty sharp volatility because so much good news is already priced in.
Okay, so with all that as context, let's zoom in on the specific numbers, the ones investors are going to be watching like hawks. What are those key forecasts versus the Q1 actuals again?
Yeah, the key ones to watch.
Revenue. Q2 forecast is $11.04 billion versus the Q1 actual of $10.54 billion.
Right.
And EPS, Q2 forecast 7.07 versus Q1 actual 6.61.
Right. And our internal take on this, what we call the Warren AI take, which synthesizes models and market sentiment.
Yeah.
It's pretty direct.
Okay.
For revenue, it basically says it needs a solid beat. Expectations are just sky high. And for EPS, it's not just about hitting the number. It must show real margin expansion, not just growth coming from higher sales.
Efficiency. That makes sense.
It's critical. Shows the underlying business is getting stronger, more profitable.
So you mentioned the growth rates before. 15.5% revenue growth, called above average for streaming.
Yeah.
And that EPS growth, 48.2%, which sounds, explosive.
Yeah, explosive is a good word.
But what are the sort of underlying questions or worries investors might have when they see those kinds of numbers?
Okay, good point. For the revenue growth, it really boils down to sustainability. Can they keep that pace up? The market's crowded. The ad tier is still, evolving.
Right. Can they maintain it?
Exactly. And for that explosive EPS growth, the big question mark is, can it last? Especially with content costs always seeming to go up.
Yeah.
Netflix is still pouring billions into content.
Yeah, that content spend isn't shrinking.
No way.
Yeah.
So if we connect this to the bigger picture,
Yeah.
what investors really need to see, beyond just, hey, we added more subscribers, is hard evidence. Proof that the ad tier momentum is actually making the business more profitable.
Fatter profits, as you said.
Fatter profits. They want to see that more with less idea in action. That means, is the average revenue per user, the ARPU from advertising going up? Are they attracting better advertisers?
Okay.
And are they getting more efficient with content? producing hits without just throwing endless money at it.
Yeah.
Maybe leveraging their existing IP better, turning shows into movies or games.
Maximizing value.
Right. So the must-watch lines on the report will be things like the cash content spend number that's projected to hit, what, $18 billion in 2025?
Wow, 18 billion.
Yeah. And their guidance on operating margins, currently pegged around 12 to 14%, things like live sports, gaming, they're still kind of ramping up. The core business profitability is what's under the microscope.
Okay, let's pivot to those pressure points then. You mentioned the stock price near its 52-week high, down $341.15. And interestingly, it's actually trading above the average analyst price target now, which is $12,225.35.
Yeah, that's notable.
We have seen some really bullish upgrades lately. Needham went to $1,500, Morgan Stanley to $14,450, but doesn't trading above the average target suggest a lot of that optimism is, well, already baked in?
That definitely raises an important question, right? Those upgrades show real confidence from some corners.
Sure.
But you have other firms like Seaport, Benchmark, basically saying the opposite, that so much optimism is already priced in. It's like you said, it leaves very little room for error.
Like walking a high wire.
Exactly. It's a great analogy. You're up high, everyone's impressed you got there.
Yeah.
But any little wobble could be trouble.
And we're even seeing a volatility warning from our pro tips tool, flagging those high multiples, the valuation ratios. Plus, technically, the charts are showing some consolidation. The RSI, Relative Strength Index, is neutral around 50.54. Moving averages are mixed. What does that technical picture tell you?
It suggests the market is kind of pausing, maybe waiting for confirmation. It's not strongly trending up or down right now, technically speaking. What the market really wants, especially at these prices, is proof Netflix can deliver more with less.
More bang for the buck.
Precisely. Not just spending more, but spending smarter, getting hits more efficiently, leveraging IP across platforms, and critically, showing that the ad tier isn't just bringing in subscribers, but bringing in profitable revenue via higher ad ARPU. It's about optimization, showing they can navigate that high wire with skill.
Okay, so let's try and tie this all together. What does this mean for you, the listener, watching this unfold? Our Warren AI bottom line really frames this Q2 as, well, that high wire act.
It absolutely is. Look, only a real beat on both revenue and earnings, the top and bottom lines combined with genuinely positive bullish commentary about margins and user engagement. Only that is likely to justify pushing the stock significantly higher from here.
So just meeting expectations might not be enough?
Probably not, given the valuation. And the flip side, a miss, if they stumble, well, our analysis flags what's called a negative 25.3% fair value gap.
Meaning?
Meaning our models suggest the stock is currently trading maybe 25% above its estimated intrinsic value based on current fundamentals. If the earnings disappoint, the stock is really vulnerable to some sharp profit taking.
Okay, quite a precarious spot then. So here's the final thought to leave everyone with. Given this incredible run Netflix has had and where the valuation sits right now, what does their strategy need to prioritize going forward? Is it just growth, growth, growth at any cost? Or is it demonstrating sustainable profitability and efficiency? What's the path to keep investor confidence high without, falling off that wire?
That's the multi-billion-dollar question, isn't it? Something definitely worth thinking about as we wait for those numbers to drop.